So welcome everyone to our webinar today titled Bookkeeping Basics. Before we dive into the presentation, we just wanted to briefly highlight both the Innovation Quarters and the Regional Business Centre. So we'll start with that and then we'll pass it over. So at the Innovation Quarters, we offer a 6-month-long incubator program that helps new startups succeed with one-on-one mentoring, programming, and training, networking and events, and a collaborative co-working space for you and your team to access. So applications for the incubator program are currently open until April 5th. We also have our quarters that are open to the public, which gives you and your team access to desk space, meeting rooms, and more. During the month of March, Wednesdays are also a free co-working days, so highly recommend coming out to check out the space. You can apply both to our program and inquire about co-working packages at innovationquarters.ca. We also have the Regional Business Centre, who are a partner of this webinar. So the Regional Business Centre is a one-stop source for information and guidance on starting, expanding and operating a business. They are proud to serve the Greater Sudbury, Espanola, Manitoulin Island and surrounding areas with services including confidential one-on-one consultations, business plan support, market research, registration and more. They also have their Summer Company program, which is for students between the ages of 15 and 29 who are returning to school in September that are looking to start their own business during the summer months. There is an opportunity to receive a grant up to $3,000. So if you are interested, you can learn more about Summer Company and the Regional Business Centre at regionalbusiness.ca. We also like to highlight the upcoming events that are being hosted. So next week, the Regional Business Centre will be hosting Power of a Business Model Canvas. And in the following week, there will be crafting a winning business plan. There's also the IQ Support for Women Entrepreneurs. This is the grant opportunities to mentorship, which will be hosted on April 18th at 12 p.m. And that is hosted by Payroll. And then there's also on the side here, you'll see the Pitch Challenge of 2024. So this is where incubator program graduates have the chance to pitch their pitches to an audience, and that is taking place on April 2nd from 6 p.m. to 9 p.m. at the Northern Water Sports Centre. So you're more than welcome to register at innovationquarters.ca/programs/seminars and events. So today we are very lucky that we have guest speakers from Baker Tilly, which is a chartered professional accountant firm here that performs tax, audits, accounting, and tailored advisory services. Their Sudbury office location is just off of LaSalle at 1174 Jerome Street. We're joined by Ginette Philion that has been with Baker Tilly since 2011 and has many years of experience prior to her start there in the world of bookkeeping. Today, she has the pleasure of helping a wide array of businesses with their bookkeeping needs. We also have Nadia Robert, who has 24 years of experience in public accounting, with the last 11 years at Baker Tilly, providing accounting and taxation services to individuals and small to medium enterprises in various industries. So welcome both Nadia and Ginette.
Thank you.
Thank you.
So I'll start with Sharon, and by all means, you can share your screen.
Absolutely. Right. So welcome everybody, and thank you for taking the time to listen to our presentation. Today it's going to be a bookkeeping basics presentation, and it's all about understanding and developing the necessary steps to maintain accurate and effective records for tax and banking and payroll purposes. Okay, so why bookkeeping and why record keeping? When you own a business, you'll want to create a system in place to keep track of all your business transactions, such as your revenues when they are earned and expenses when they are incurred. This will create complete, relevant, reliable, and comparable information about your business activities, helping you make informed financial decisions and see how your business is doing. For example, if you compare your budget to actual numbers, you'll be able to see how well you're on budget and what you need to tweak and cut and or maybe edit accordingly, just to make sure that you stay on budget. And you can also compare your current year's numbers to prior years to see how well your business has been doing over the years and what your trends are and what's working for you, and if you have different lines of business within your business. Another reason to keep complete financial records is to have your revenues and expenses categorized to prepare and file your personal and or your corporate taxes. I don't know the audience today, so we're just going to be talking on generic terms of sole proprietor and corporations as well. So it would be to prepare your corporate and or your personal income tax return, so your business schedule on your personal tax return. Since Canada operates on a self-reporting system, which means that a taxpayer reports the revenues and expenses on their tax returns to the Canada Revenue Agency, based on a self-assessment. Therefore, CRA will generally assess the tax returns as they are filed by yourself and or your accountant. And sometimes they do request supporting documentation from a sample of taxpayers, just to make sure of the integrity of our self-reporting tax system. Therefore, it's important for you to keep copies of the supporting invoices and receipts. And CRA's requirements to keep your receipts for a period of 6 years from the end of the last tax year that they relate to. And just to add another note, it's just as important to have safeguards in place to protect your documents. So if you keep your documents electronically, you'll want to ensure that there's a backup in place in case of your hard drive failure. And the same could be said for paper. So if you have paper documents, you'll want to ensure that they're in a fireproof and dry area of your home or your business to keep them from fading and or fire. Okay, so now that we know the importance of bookkeeping, let's move over to how to select the right software.
Okay, so that would be my department. So when you're thinking about setting up your company and your business, what you want to do is decide how you're going to keep track of all of these records. So are you going to use a cloud-based solution? So on this list of selecting the right softwares, we have softwares that are desktop-based softwares and cloud-based softwares. So the difference between the two is the desktop solutions, you need to have them installed on an actual drive on a system, and you have to be attached to that system. So I mean, if you're on vacation, you have to bring that laptop with you, or you have to be able to access the server that this desktop software is saved on. If you're choosing a cloud-based solution, you can access this from anywhere that you would have internet access. So many of these you can access from an app on your phone, you can access them from an iPad, or just any laptop that you would bring with you on vacation. Or, I mean, depending on whether or not you're working from home and have from the office, if you just want to be a little bit more mobile, cloud-based solution is probably the way to go. So the more popular ones are on this list: QuickBooks Desktop, QuickBooks Online, which is also known as QBO. There's Sage 50, which isn't quite as popular as they used to be, maybe 10 or 15 years ago. However, it's still a solid solution. The online Sage is an option. There's other online softwares as well. So if we're looking at Xero, Wave, FreshBooks, so there's a few of them that have monthly subscription fees, and then there's a few of them that will offer free bookkeeping software. However, if you want to add, let's say, payroll to that solution, then there would be a upcharge for the payroll. It really depends on how intricate and the different how you want to categorize your books. So it's a good idea to always kind of review. Most of these softwares have offer like a 14-day trial. So if you're looking to try a couple of different ones, you can always sign up for the trials and see what works best for you. Of course, if it's a smaller business, you can always use Excel to categorize your income and your expenses. And if you're, in a growing business where you're looking at some of these softwares and you're saying this just doesn't offer the right level of options for my business, there's also integrated apps. So when you're looking at more so on the cloud-based solutions, there's the option to add integrated apps that would connect and speak to these softwares. So there's integrated apps for time tracking, receipt management, mileage, your accounts receivable, your accounts payable, your inventory tracking. There's some payroll service providers where, they look after some of the other payroll related tasks for you if you're using these softwares. But yeah, so if you have any questions, we can always look at different softwares towards the end of the presentation, but these are a good list of options for you. Once you choose your software, you're then going to set up your chart of accounts. So what your chart of accounts is it's a list of all of the accounts that your business will use. So this usually is comprised of your bank accounts, your accounts receivable, fixed assets, accounts payable, credit cards, your loans. So bank loans, mortgages, vehicle loans, business loans, those would all be long-term borrowing. And then your drawings or owner's contribution withdrawals, so like you're due to from shareholders. So depending on whether or not you're incorporated, just the name of this account would change. And then of course you would have your revenue and your expenses. And the reason this is so important to make sure it's set up correctly is just all of these accounts will come up differently on different reports. So if you're looking at something like a profit and loss, you just want to make sure that you're only looking at your revenue and expenses, and you don't necessarily need to see the rest of those accounts. However, if you're looking at how your business is doing, you're going to want to look at a trial balance or a balance sheet, which will include the other accounts. So it's always good to either use one of the templates. Many of those softwares that I mentioned earlier have a template for the different types of businesses. So usually that's a good start if you start with the template that's offered and then just add to it depending on your own needs. If not, then, if you're working with an accountant, it would be a good idea to check with them to see, if they have a suggestion on what your chart of accounts should look like. Okay, so when you're setting up your bank and credit card accounts, the one thing to remember is that it's very important to make sure that you're keeping your business and your personal transactions separate. It's just easier to track that way, especially for reconciliation purposes. So the idea is that you would have, a bank account and a credit card account in your business name, and then you would use that only for business, and then use your personal accounts for your personal transactions. What you want to make sure is that you're setting up accounts under the company name. So you'll have the two separate statements, and every month you'll make sure that you enter all of the transactions that have passed through those accounts. So whether it be the bank account or the credit card in your software, and there's many ways to get that information into the software, you would just make sure that everything is recorded. This way, you're not missing anything. You haven't missed out on any expenses. You're not missing any revenues or deposits. You're recording your insurances and your bank charges, all of that. And most of these softwares come with a reconciliation module. So it makes it nice and simple. You would reconcile your accounts and have a physical document to prove that you've reconciled this. It's also important to remember that in the case of a CRA audit, the CRA auditor could request copies of your personal bank statements. So just keep that in mind, especially if you're mixing some of the two here and there. So when you're looking at your AR and your AP, so accounts receivable and accounts payable, this is very important because you want to track who you're invoicing and who you're paying, right? So it's really tracking the money in and tracking the money out. So customer invoices and payments, these are the people who are coming and using your business, or that you're, going to do work, depending on what type of business you're running, and you would invoice these customers. So you would invoice these customers at the date when the work had occurred or the service was offered. And then you would be waiting to receive payment. So while those invoices are waiting to have payments applied to them, so if people aren't paying you as soon as the job is done, that's your accounts receivable. So that would be what your subledger is. Those are the invoices from customers that you're waiting to be paid for. On the opposite direction, the vendor invoices and payments, those are people that you're paying, right? So you have all of your supplies, your cost of goods, everything that you're purchasing in order to be able to earn that income. So they will be sending you invoices. You'll be entering those invoices at the date on the vendor invoice, and then you would pay it at a later date. So this is where the cash versus accrual accounting comes in. So if you're doing it on a cash basis, you would do it based on when the payments are coming in and out. The more common solution is on an accrual basis. So basically when the expense was incurred and when the revenue was incurred, and then the payments come in at a later date. What you have to remember is that once you've created something in your books, it's not an ideal situation to go in and delete or void anything, especially not in a closed period. So if either A, your year end has happened, or B, your HST quarter has happened, what you would want to do is make sure that, if you have an outstanding invoice and it needs to be adjusted, you would create a credit memo versus actually changing the invoice. And most of the softwares mentioned have the option to create a credit memo. So the screens are very similar and it makes it very simple for you to be able to kind of go through the different options. Now, if at the end of the year or at the end of a period, you've realized that you've invoiced this person, you've followed up multiple times, and you're not expecting to be paid, this is where the bad debt would come in. After a conversation with your accountant, you would decide which items fall into the bad debt category, and you would create a credit memo with an item to bad debt. And that would just record that and take it out of your AR so that it's not money that you're expecting to receive. On the flip side, if that happens and there's an amount that's written off and all of a sudden the person decides to come back and pay, then you would just re-enter the invoice and put it for the bad debt recovered, right? So instead of going back in and playing with the original invoices, you just have to make sure that as things are happening in your business, you're creating new steps and you're going through the process of adding different items, I guess, to keep track of what actually happened. This way, it kind of leaves a trail of, this is where it started and this is where it ended. Another good idea is that if you're send statements of accounts to your customers. So, you have a list of customers and in total they owe you 30,000 and you're waiting to be paid. Well, sometimes people get these invoices. If they receive a statement at the end of the month, that's also a good reminder to them that they still owe you that money and you're waiting to receive it. And again, on the flip side, agreeing your statements of accounts from vendors. So depending on what type of business you're in, if you're, a mechanic shop or, construction based, if you're looking at all of the vendor invoices, you probably have multiple small invoices coming in from your vendors. So bills coming in, you just want to make sure that you're not missing any of those, right? Because that would affect the reporting for reporting purposes when you're looking at your income versus your expenses. It would also affect the HST if you're filing HST. So what you want to make sure is that you have a vendor statement and you're going through your set of books to make sure that you're not missing any of those vendor bills that are on that statement. And if you are, you'll either have to reach out to the vendor and say, hey, I don't have a copy of this invoice. Can you please send it to me so I can enter it in my books and make sure that I'm up to date? And all of these things are very important to do on a monthly basis. If you let it go too long, sometimes it's just harder for the vendor to go back and provide you what you're asking for. And it's harder to go back to your customer and say, I realize you haven't paid your bills. So, it's good to follow up on a monthly basis with all of these points.
Okay, so now let's move on to the inventory. So inventory consists of the goods that you sell. And it is important to keep track of your inventory in order to setting your prices and to ensure that your margin is profitable. So you want to make sure that you're keeping track of the cost of your inventory as well as how much inventory is coming in and out, just to control your costs. And it's also a good way, sometimes you have to get your inventory insured, so you do have to keep track of your insurance for those purposes, as well as budgeting, as I just mentioned, and to ensure that you always have the right level of inventory on hand if you are actually producing something or if your items come in they take a long time to ship to you. And inventory tracking involves physical counts of your inventory, which should ideally be done at least once a year, which would be at your year end. So if you're a sole proprietor, you should do it at December 31st. And if you're incorporated, then you should do it on the last day of your corporate year end. So if you're a March 31st year end, you should do it on March 31st. But it's not a bad idea if you have a huge amount of inventory to do it twice a year or every quarter if necessary. And if at any point some of your inventory becomes obsolete or gets damaged, you can reduce your inventory on hand to adjust for the items that are obsolete or damaged in your book. So you would have an account called inventory. When you purchase the inventory, you would include it in that account. And then when you sell it, you would then take it out of the inventory, excuse me, and include it in your cost of sales. So if when you're doing your inventory count and you notice that there's damage or missing items, then you'll have to adjust for that inventory, for your physical inventory count to make sure that it agrees to the inventory that you have in your software. And there are different ways to do the inventory count. Like a lot of small business owners, they still use the inventory count by hand and then just put that in an Excel spreadsheet to ensure that all of the inventory is accurate. However, as business owners, we realize, this is time consuming for you to do that because if you own a shop and you have to do the inventory of everything that you have on hand in your store, this means closing your store for a few hours to do your physical inventory. So it's important to maybe find some other tools to keep track of your inventory a little bit quicker. While others use software such as QuickBooks or Sage 50. But as Ginette mentioned, Sage 50 is a bit of an older software. And then if you have more complex inventory system, you can always use your inventory or your point of sale apps. So these are all tools that can integrate with your bookkeeping software. There are some examples such as Shopify, Fishbowl, Lightspeed, and these can all integrate with your QBO software, okay? And an important point to note regarding your inventory is that it is always recorded at cost in your books and not at the fair market value or selling price, okay? So now let's move on to fixed assets. Oh, sorry. So fixed asset or capital assets. What is a fixed asset? So a fixed asset is usually a long-term tangible asset. It can be intangible, but it's usually tangible, that is acquired, which means purchased, constructed, developed, etc., by your business, and it's used to generate revenues. And normally it will have an estimated useful life of usually more than 1 year. Okay. And examples of fixed assets, they include but are not limited to computers, printers, desks, vehicles, building, and machinery. And then on the flip side, some of the examples that can last more than a year, however, they're not capital in nature and not considered fixed assets, would be your employees, paper, and raw material. Okay. And then if you're just starting up a business and you already have assets such as your computer or any kind of machinery, you can roll over those assets into your business. And this is usually done at the fair market value on the day that you begin your business and that you start using that fixed asset to generate revenues. I think for this, it becomes complicated, especially if you're incorporated, because if you're rolling over assets into your incorporation, it does involve filing of specific forms with CRA in order to do so. So we do advise that you do contact your accountant just to make sure that you're not offside on anything here. Okay. And then capital assets are amortized over their estimated useful life for accounting purposes. So that is what we call the amortization of the assets. For tax purposes, it's called capital cost allowance. And then you can deduct for capital cost allowance according to CRA's prescribed capital cost allowance rate. So there's a rate for every class. For example, computers, they have a rate at 55%, furnitures and fixtures is 20%, and vehicles are at 30% if they are not electric and just a regular passenger vehicle under $36,000. So there are rules to consider when you do have a capital asset, but very often the businesses will adopt the same rules as the capital cost allowance rules, just so that their costs in their books match their assets on their balance sheet for tax purposes. Okay. All right, now we've looked at the assets, so we can move on to the profit and loss. So the first thing that everyone is usually concerned about are their revenues. So you want to make sure that if you're registered for HST, that you're recording your revenues and your HST in separate accounts. And so for example, if your gross revenues invoiced to the clients was 1,000 and the HST collected was at 13% at $130, you would record $1,000 in your revenue account, and you would record $130 in your HST collected or payable account. So the HST is payable is recorded in a balance sheet account, and your revenues are in your profit and loss. Okay. And it's important to do so because then you're going to be reporting this number to CRA on your HST return minus the HST that you've paid and any installments that you've paid when you're filing your HST return. If you're selling items online or to different provinces and countries, the HST gets quite intricate. So it's important that you do refer to CRA's HST guide to determine your place of supply. It's what they call a place of supply rule. So depending on where you're located, if you offer services, it depends on the type of services that you offer, where those services are rendered. Land has different HST implications. So we won't get into that because we could talk about HST for hours. However, if you do have something, we would just guide you to go onto CRA's website and look up the guide to look at your place of supply rule if you do deal with online sales. Okay, it's very important to ensure that you're charging the correct rate. Okay, and also HST that you collect does not form part of your revenues, as I mentioned earlier. It's a liability to CRA, so you got to treat it as a trust account because you are collecting it, but then you're remitting it net of your HST paid on your expenses to CRA. Therefore, I think this is an important point when you're sending a potential client a quote. So you want to make sure that if you say in 20,000 inclusive of HST, then you have to keep in mind that your revenues are not going to be 20,000. It'll be the 20,000 divided by 1.13, and then the balance will be HST. And so that's very important to make sure that you're quoting your jobs correctly, and or any kind of sales order, just to make sure that you're not, you're operating at a profit and that you're not going to be selling yourself short before you even fulfill your contract or your order with your potential client. And then when to apply for HST or when you have to register. So in a nutshell, you should register for HST as soon as your sales hit $30,000 in the year. So if you have a calendar year and you start in January, so if we started our business on January 1st and we've already reached 30,000, then we need to register at that point in time, and then we need to start collecting right away. If you wish to register for HST, even though you don't hit the 30,000, you can still register voluntarily, even though you're not a small supplier. And I'm not sure what kind of lines of businesses that everyone's in, but there are some exceptions where some businesses do need to be registered and start HST on the first day that they supply their taxable services. An example of that would be taxi drivers. So if they're self-employed and they are taxi drivers, they need to be registered whether they hit the $30,000 threshold or not. Okay. Then there are other types of services. So there's something that we call exempt services. exempt supplies or exempt services. So if you provide exempt services, you cannot register it for an HST account, and you're not entitled to claim any input tax credit, which is the HST that you pay on your purchases. So an exempt supplies, an example of that would be like a dentist that offers non-cosmetic services. As soon as they do offer or they render cosmetic services, a lot of the times the HST will be applicable on that, or your any kind of doctor, they offer services that are exempt. Therefore, they do not need to be registered for HST. Okay. And then there's also other items like zero rated, and then just taxable, which is the whichever rate that you do qualify, and you do have to charge HST on everything. So again, we would strongly guide you to refer to CRA's HST guide for specific information on the rules and regulation that apply to your specific industry and line of business that you're in order to determine the registration dates if you do need to register for HST, as well as the details on exempt, zero rated, and taxable supply services, and also the rate to charge depending on which province you're in. Okay. And then another important point regarding the HST. So once you are registered for HST, you must continue to charge HST on all your taxable supplies and services from that point on. So it's not a $30,000 per year. As soon as you're registered and you have an HST number, you should be charging it. Okay. And now let's move on to the expenses. So what expenses can you deduct? You can generally deduct most expenses against your revenue, provided that they are incurred to earn business income and they are reasonable and current. There are some exceptions, such as the membership fees in a golf club that you pay. These are not deductible. So even though you did incur them and you might meet some clients there, the actual membership fees themselves to the golf club, are not deductible. And just like the HST that is collected on revenues, it's important to track the HST paid on purchases, which are often referred to as input tax credits, so ITCs, as these will be reported on your HST return. So you'll be reporting, as I mentioned earlier, HST collected minus HST paid, or ITCs, and then that will determine your balance owing to CRA. And if you've made any installments, that will further reduce the amount. So again, if we use the example of an office supply, if you purchased office supplies for $100 plus HST, so it's a total of $113, you would record the $100 under office expense. And then the $13 would be recorded as an account on your balance sheet as HST paid, or the HST payable account to offset against the HST collected. Okay, and then once again, as we mentioned for the revenue, you have to determine what rate, depending on who you're selling to and where your place of supply rule is. It's also the same when you're paying for HST. So keep in mind that not all expenses are subject to HST. And you can incur some expenses outside of Ontario and other provinces where the GST HST rate might be different or not applicable, such as in the US. So for example, if you pay someone for services or for any kind of expense that's business related in the province of BC, you would have to pay them 5%. You would have to pay them 5% HST and GST, and 7% PST for a total of 12%. And therefore you could only claim the 5% HST as a GST as HST paid on purchases on your HST return, and the remaining 7% of the PST would have to be added to your expense, account. So whether it's inventory that you purchase from there, the 7% PST paid would have to be added to the expense and not as HST paid. Unless, of course, you're registered for PST in Vancouver, then you would file your own return, and then that would be eligible, but other than that, it is not. And there are also other expenses such as insurance for your vehicle or your home that do often say taxes paid, and that is PST. So there's no HST on insurance, therefore it should not be broken down. Okay. All right, so we'll go over some of the more common expenses that you can deduct as a business owner. So one of them being meals and entertainment receipts. So generally, meals and entertainment expenses are only deductible at 50% of the full amount for tax purposes. So in your books and records, you will include the full amount of your expense. However, for tax purposes, it's only deductible at 50%. And it's because CRA has the premise that you have to eat wherever you are. So that's why it's only at 50%. And the HST that you pay on these expenses should only be deducted at 50%. Okay. And then furthermore, so to substantiate, if you go out with a client, you're meeting a client or a potential accountant or potential employee somewhere, and you have a meeting during a meal at a restaurant somewhere, to substantiate that your expenses is related to generating business activities, we suggest adding the purpose of the meeting as well as the names of the individuals attending the meeting at the back of the receipt or in your accounting software note if you just take a picture. Okay, just so that if CRA does audit you, then you have all that information at hand. And you don't have to go back and try and figure out in your calendar what you did. And being deductible at 50%, there are some special circumstances where you would be able to deduct 100% of the meals and entertainment. So an example of that would include paying for conference fees, where the price of the conference, hotel, and meals were all inclusive in your fees that you had to pay. But however, if you obtain a receipt of that conference, then it would have the breakdown of the conference fees, the hotels, as well as the meals, then you would be subject to the 50% deduction rule for the meals as well. Okay. Another one is if you have employees and you do have a party or a celebration with them or for them, and all the employees are invited, so then that one is not subject to 50%. It's a bit of an exemption, so you can take 100% of that expense. So, but I would strongly advise that you do look at the rules and conditions per CRA's guidelines to ensure that you're including the correct percentage based on each situation and event. So another common expense is home office expense. Sorry. So are you eligible to claim office and home expense? So in order to claim your office and home, you must meet one of the following conditions. It has to be your principal place of business, or you use the space only to earn your business income, and you use it on a regular and ongoing basis to meet your clients, your customers, or your patients if you're in the medical field. And we strongly, obviously, always track your always track all of your expenses. You can deduct part of your maintenance costs, such as heat, home insurance, your electricity, and cleaning materials. You can also deduct part of your property taxes and your mortgage interest. However, you do have to calculate the percentage to be claimed as a business expense. So to calculate the part that you can deduct, you have to use a reasonable basis, such as the area. So that's the main one, which would be the square footage of your workspace, but divided by the total square footage of your home. If you use part of your home for both business and personal living, and you don't know the square footage, you can also use another reasonable basis, which is to calculate how many hours in the day you use the rooms for your business, and then divide that amount by 24 hours. And then you can multiply the result by the business part of your total home expenses. And then that will form your office and home expenses that you can deduct on your personal or your corporate income. And also if you rent your home instead of owning it, which what I mentioned previously, which is property taxes and mortgage interest, but if you rent your home or your apartment, you can still deduct the rent and any expenses that you incur for living expenses. So if you have to pay insurance and telephone and so on and so forth, okay. I will just state, however, that when you are preparing your personal tax return, if you are a sole proprietor, you are limited as to the deduction of your office and home. You cannot deduct those to create a loss. So if you're already operating at a loss, you can claim it on the return, but it'll be carried forward to the next year for you to deduct it in the next fiscal period if you do have some business income at that point in time. And once again, just make sure that you track the HST if you're registered for it, that you track the HST paid and only calculate it and include as an input tax credit the actual business use portion of it and not the full business use, the full HST paid, sorry. Now, the next slide, so let's move on to vehicle usage for business. So again, you can use your vehicle for business use. If you use it more than 90% of the time for business use, we would strongly recommend that you do register the vehicle under your corporate name or your business name. And then the expenses that you can deduct here are your fuel, oil, interest if you have a loan, insurance, license and registration, maintenance and repairs, and leasing costs. And then you should also track your motor vehicle expenses. And you can only deduct the part of the expenses that you pay to earn income. So you'll have to keep track of your mileage as to how much mileage that you've traveled for business use versus total personal use if it's a personal vehicle. And then you calculate the percentage that was traveled for business use over the total kilometers traveled, and then that'll give you your percentage, and you can deduct that portion of all the expenses that I previously mentioned, and same with the HST that you've paid on the vehicle as well, the vehicle expenses. Okay. I also forgot, sorry, to say parking fees are also 100% deductible if it's related to strictly a business venue or a business meeting. However, that does not include parking fines. Okay. And if you do have a business vehicle that is registered under your business and your employee uses the company vehicle for their personal use, so let's say if you own a roofing business, you have 3 vehicles that are registered under the corporate name. One of your employees takes that vehicle home at night, and then they use that vehicle since they don't have another one for personal use during the weekends and on their personal times. You would have to calculate a taxable benefit and a standby charge to that employee based on the number of kilometers that they've traveled for personal use, that they've used it. And you include that benefit on their T4. Okay, CRA has a calculator online to calculate this for you and to help out. Okay. Now, the last piece of the expenses. So when we have expenses that are paid personally or have capital contributions, which just means that you've put money into the company or you've rolled over something, you've rolled over a fixed asset into the company, and or you have withdrawals from the business or corporate bank account. So all of these expenses should be recorded through your drawings And as Ginette mentioned earlier, depending on if you're a sole proprietor, so that account will be named drawings. And if you're incorporated, we normally name these accounts due to, from, or shareholder advances. Okay, so it's important to keep track of the amounts that you've put into the company versus what you've pulled out, especially if you're incorporated, because when you're incorporated, the net of the monies that you've withdrawn versus what you've put in, if that amount's higher, the amount that you've withdrawn, then that will determine if you're issued a dividend and or wages from the corporation. Whereas if you're a sole proprietor, you're taxed on your net income regardless, so it doesn't really matter, but it is important for you as a business owner to know how much money you need to live and how much money you're pulling out of the company, because that's also a deciding factor when you're thinking, when your revenue levels are really high, if you're a sole proprietor, as to whether you want to incorporate or not. If you're pulling out all the monies that are left after business expenses, then there's no benefit of being incorporated, because you're not really going to benefit from the lower tax rates of incorporation. Okay, so now let's move on to payroll.
Okay. So when do you need a payroll account? Well, the answer would be when you start hiring employees. So if you're opening a business and you're planning on having employees on payroll, as soon as you start paying somebody, you need to call CRA and set up your payroll account. So that would just be in addition to your business account that you already have, and there would be deductions that you need to pay to CRA. So we'll go over that a little bit later. What's really important is that when you're hiring somebody, you want to make sure that you have all the information that you need. You'll have to prepare a T4 at the end of the year, so it's very important that you have the person's full name, full legal name, their address, their date of birth, and then their SIN number. So there are TD1 forms on CRA's website. So there's two different forms. There's one for federal, so TD1 federal, and then TD1 Ontario forms. If you Google that, you'll be able to find the forms in PDF format, and you make sure that you print those and you hand them to the employees and that you have them back before making your first payment to the employee. I find it's easier if you make sure that you get it at the beginning. That way, if there's, if they leave or you need to find them, at least you can still issue the T4 at the end of the year. There's a couple of different ways that you can prepare payroll. So there's a CRA payroll calculator online. If you Google PDOC, PDOC, the calculator will come up. And in there, you can use it for individual payrolls. However, if you're doing it this way, just keep in mind that you're not going to have the backup. You're not going to have reporting. You're not going to have anything saved. So you have to create like an Excel spreadsheet or something that you're using to keep track of all of the gross payroll, the CPP, the EI, and the taxes paid. And so that way at the end of the year, you can prepare your T4. So that record keeping is extremely important if you're using the CRA payroll online calculator. My recommendation is that you would either use your bookkeeping software. So if you're using QuickBooks Online, QuickBooks Desktop, Sage, they all have payroll modules. As I said earlier, there is an additional fee usually for using these modules. However, I definitely recommend using them. The price that you're going to pay is definitely going to offset the headache that you're going to have later on, making sure that you had proper record keeping. There's also online apps. So like there's, Desjardins Payroll, there's WagePoint, Payworks. There's a lot of different payroll service providers, which are usually very cost effective. And if you sign up for a payroll service provider, they usually look after some of the remittances for you. So they'll look after remitting the funds to CRA. They'll look after, sometimes remitting the funds to WSIB. You just have to really make sure that you understand what the package includes. Go to the next slide. Okay, so another thing to make sure that you're aware of is that if you have employees and your employee either chooses to leave or you ask them to leave, as soon as there's a gap of 7 days from regular employment, you would need to create a record of employment. So what this is an ROE. So anybody who's ever, left a job, you probably remember this form, and they would need that to be able to apply for EI. Even if, they're temporary employees and you're planning on having them back, you still prepare a record of employment because you don't know a date, and then you would have Service Canada looks at the last year of record of employments. So in that record of employment, you would make sure that you put their last day worked and what they were paid. It details all of the gross pay. It also details if you're planning on having them back and the reason why they've left. So whether they've quit, you let them go, they're going on maternity or paternity leave, maybe they're taking a sick leave of some sort. So you just have to make sure that you have all that information. And another thing to keep in mind is taxable benefits. So if you're paying an employee and you've decided that you're going to offer benefits, so health benefits, insurance benefits, if you're letting them take a vehicle home, a work vehicle home, you have to make sure that you understand that there's taxable benefits. So things that you would pay on behalf of the employee that they would normally have to pay for themselves. So there's a chart online on CRA's website where you can kind of see what qualifies as a taxable benefit and what qualifies as a reimbursement and so on. So it's a good idea to make sure that you understand the difference and that you add that to payroll as payroll is happening. T4s and T4As. So the T4s are the T4 slips that you would prepare. They're always due at the end of February. So this year was February 29th. We had an extra day, and it just includes everything that you've paid the employee, all the CPP and EI and taxes that they've paid. There's also other boxes on the T4 for you to be able to kind of relay to CRA that this employee paid for medical benefits, had a taxable benefit. There's different boxes for all of that. So there's always a good example on CRA's website when you want to look to see what all the boxes encompass. T4As and T5018s are very similar in in information. So this is when you would pay a subcontractor. So in any other regular business, if you paid a subcontractor, you would prepare a T4A for that subcontractor for the amount that you've paid them throughout that fiscal year or the calendar year, sorry. That is also due. The T4As are due on February 28th or February 29th during a leap year, along with the T4s. T5018s is if you are a construction-based business, then you would prepare T5018s versus the T4As for the subcontractors that you've paid. And again, this is for construction-based businesses. If you're a regular-based business and you paid a construction business, you would prepare the T4A and not the T5018. But if your source of income is construction-based, then you prepare the T5018s. And these are due 6 months after the fiscal year. So if your fiscal year still ends December 31st, these T5018s would be due on June 30th versus the February 28th. And these all need to be filed with CRA. So another thing to keep in mind when you're starting a business where you're going to have payroll is you have to determine whether or not you need to register for WSIB, which is the Workers' Safety and Insurance Board. If you're unsure whether or not you need to register for WSIB, I would call the WSIB office and talk to one of their contacts and one of their workers, and they would be able to explain to you whether or not this is something you have to register for. If it's something that you do have to register for, most of the reporting requirements are quarterly, so January to March to April 30th, and so on. If you're big enough that you have a monthly WSIB, you have to keep in mind that at the end of the year, you need to file an annual reconciliation, which are due on March 31st. Another thing to keep in mind would be your employer health tax, also known as EHT. Currently, the exemption for EHT is $1 million in payroll. So if your payroll isn't going to reach $1 million, this doesn't apply. However, if your payroll does reach $1 million, you need to register with the Ministry of Finance and report your EHT. So it would be any earnings over the $1 million would be subject to a 1.95% rate, and that would be payable to the province. And we mentioned the record of employments earlier. A good way to file your record of employments are online now. So if you contact the Employer Contact Center at Service Ontario, they can help you get set up so that you can file your ROEs online. This makes it instant. Employee leaves, you can go ahead and prepare the ROE, file it. The employee will have a copy in their Service Canada account, and Service Canada will have the copy instantly. Another thing worth mentioning with the for the record of employments is just that, you know, less and less are we doing actual paper ROEs. So it's just a lot of the time, some of these softwares that you'll be using for payroll. So if you're using like a payroll service provider, again, like Payworks or Desjardins or anything like that, they will actually prepare the ROE. You just have to initiate that ROE within the system, and then they file that ROE with Service Canada. Something like QBO or Sage, where you kind of control the payroll and what's happening, it will export a report for you to use to be able to transcribe that online or upload it into Service Canada. So with payroll also comes government remittances and due dates. So it's really important to remember that the payroll deductions that you're deducting from the employee are due to the government. So that isn't something that you can keep. So you deduct the CPP, the EI, and then you have an employer portion as well that you need to add. So for CPP, you match the amount that you're deducting from the employee. For EI, the amount that you're deducting from the employee times 1.4 is the amount of the employer portion. So when you're remitting to CRA, you need to make sure that you remit the income tax, the federal and provincial income tax deducted from the employee, both CPP portions, the employee and the employer, and then the EI employee and the EI employer portion to CRA. Payroll deductions are due on the 15th of the month. So if you're a monthly filer, your January 1st to January 31st deductions would be due February 15th. If you're a quarterly filer, then your January 1st to March 31st will be due April 15th. Now the payroll follows the calendar quarter. So you wouldn't have like an off quarter. So just it's important that by the 15th of the month, you make sure that your payroll deductions have been paid. The WSIB is due, you usually have a month for WSIB. So if you're a quarterly remitter for WSIB, it's again January to March, due at the end of April. So EHT is due in the month in which you hit the million. So if you get to a point, you know, in June and you're seeing that you've reached $1 million in gross payroll that you've paid to the employees, then in that month, whatever the overage of that $1 million would be due by the 15th of the following month to EHT. So don't combine those payments. EHT and payroll deductions are not paid to the same government entity, so you have to make sure that you make the two separate payments and set that up differently in your online banking. The other thing to remember is HST, when is that due? So it really depends on how often you have to file your HST. So if you're a monthly filer, the HST is due, you know, for January 1st to January 31st will be due at the end of February, and so on. If you're quarterly, now the HST doesn't necessarily have to follow the January to March calendar quarters. It can follow a fiscal quarter as well. So you have to really make sure that when you register, you have a clear understanding of when your HST is due. The quarterly HSTs are also due the month after the quarter finishes. So for the sake of keeping things simple, if you have a January to March HST, that will be due at the end of April. So if you're an annual filer, it really depends on whether you're a sole proprietor or corporate return. So just make sure that you know your deadlines. So usually it's, you know, the HST itself, the amount that's due is due April 30th. However, you have sometimes a little bit longer to make the remittance online, like to actually report to CRA. So just when you do set up your HST account, you make sure that CRA provides you with a list of when your returns are due and that you follow that. Tax returns are due April 30th. If you're a sole proprietor, the personal income tax return would be due June 15th. However, the tax that would be due, the monetary value, would still be due April 30th. And same thing with corporate returns. Corporate returns after your year end, you usually have at the very latest 6 months to file the return. However, depending on what type of business you are, your actual monetary value of the taxes due would be due sometimes 3 to 4 months after the year end. So it's really important to follow up with your accountant to make sure that you're aware of all of your deadlines.
Okay. And then, as we've been mentioning throughout the presentation, CRA website is a great resource for any kind of tools such as online payroll calculators. If you do not purchase the software to calculate that, it's important to always make sure that you're on top of it as it changes, and the rates do change. Therefore, if you do have a software version, I think it's important to note that you should be always paying to update that payroll module so that, yeah, you have the updated yearly rates. The other thing is CRA My Business Account. So that is a great tool or a great account for you to create as a business owner, since you'll be able to access and view all of your correspondence that CRA gives you from that account if you wish to do so and not receive any more paper documents. You do receive an email to state that, you know, you do have mail. It doesn't necessarily email you to let you know that, or to give you a notice of assessment per se or anything. It just gives you the notification that you do have mail. So to log on, that's your trigger to log on to your account, and then you can view your HST account and or payroll or corporate tax account, whichever business, if you're incorporated or sole proprietor. The other thing to note too is just paying your bills and government remittances online is getting more and more handy. Effective January 1st, 2024, any payment or remittances to the Receiver General of Canada, CRA, should be made as an electronic payment if the amount is more than $10,000. Otherwise, there's a $100 penalty for every payment that is over the $10,000 threshold.
I think we skipped one.
I did? Oh, sorry.
Okay, so you know, to add to all of the apps that connect with these accounting softwares, a good idea is to make sure that in order to be able to keep a copy of all of your receipts, your invoices, your credit card receipts, there are apps that you can use, and these are three of the more popular ones. One of them is Dex, which was formerly Receipt Bank, so if you had any dealings with them in the past, HubDoc and Auto Entry. So these are three different softwares where you can use your phone, you can take pictures of the receipts, and it actually categorizes them. Like it files them in their own little folders in this online software. So it makes it nice and easy to be able to go back and reference back to these receipts. In these cases, most of the time, if you're connecting this to a cloud-based accounting software or a desktop when you're using QBO and Sage, you can actually categorize and post from these softwares into your accounting software. So it would basically be you take a picture of it, you categorize it in that Dex or HubDoc, and then it would automatically post into QBO or QuickBooks Desktop or Sage for you. And then from there, you can mark your bills as paid, or you can do whatever you need to do with them. I strongly recommend that you use this kind of software, especially if you find you have a hard time keeping track of some of the receipts. This way, there's always a PDF copy. And if CRA were to audit, you can download all of the receipts that you need in order to provide that to the auditor.
Sorry.
So that kind of goes hand in hand with the filing system. If you're choosing to keep paper copies of your receipts and your invoices, just make sure that you come up with a very simple to follow and very organized filing system. So whether you're doing it by vendor, whether you're doing it by month, whether you're stapling all these receipts to the credit card statements, or whether you're, stapling all the bills along with the monthly bank statement, depending on how many you have, you just find a system that works and make sure you stick with it and you keep it kind of going month to month. Just that way, whenever you do have to go back and somebody is asking you for something, you'll be able to find it nice and simply.
Okay. And then the filing your taxes, just a reminder, I think I've mentioned it previously, but you're only taxed on the income your business generates, which is net of expenses. So it's your gross revenues less your expenses. So you also need to consider any adjustments that are needed at year end, such as restricted expenses, as we mentioned. There's meals. There's also, for tax purposes, if you're incorporated, you're restricted with the incorporation costs. These should be capitalized. And non-deductible expenses such as life insurance, which is not always deductible, as well as golf memberships, as mentioned earlier. So just be mindful of that. And then do we have any questions? Do we have time for questions? You're muted, Caitlin.
Thank you. We'll give it a couple of seconds. If anyone does have a question, please feel free to use the chat.
If there's questions afterwards, you can forward them to us.
Perfect. Yeah, sounds good. Doesn't look like there's any coming through. Maybe I'll just ask one as well. Maybe just one in terms of bookkeeping. Presentation was very helpful, lots of things to consider. Someone who's first starting out, what would be like your one piece of advice for them to do in terms of would it be first to look at like what their system looks like, look at what that app works best for them? What would be like a piece of advice you'd have?
I would definitely, recommend that somebody utilize those free trials. So find one that works for you, find one that, it really depends. Some people have very specific businesses, and there are certain softwares that are specific to that type of business, right? So when you're looking at like law offices, there's a lot of softwares that are made and actually, built to be able uh, to be used in a law office. And same thing with construction. So sometimes there's a lot of projects going on. So you want to make sure that the software you're using has a good project management. So it's a really good idea just to utilize those free trials and just to see what works best for you.
Okay, thank you. Sounds good. So it doesn't seem like any more is trickling in. So maybe we'll leave it at that. But Nadia and Ginette, thank you so much for your time today. It is very greatly appreciated. And like I said,